Hello, everybody. This is Tom Citino. I'm the calling officer at the Federal Home Loan Bank of New York. Many of you know me. I cover predominantly upstate New York credit unions. And we're here with the whole team. Alex Cernoza is present as well. He covers a lot of the Long Island credit unions and also New Jersey. We also have Angel Santos. He's a new member of our calling officer team who will be covering credit unions as well. And we're also here with the new president at the Federal Home Loan Bank of New York, Jose Gonzalez. And many of you may have met him before, but he just started on April 1st of this year. And I wanted to turn the mic over to him to say a couple of words before we start the webinar.
Thank you, Tom, and welcome to all of you to the third installment of our Credit Union Asset Liability Management Series, today conducted by Frank Farone, Managing Director of Darling Consulting Group. Today we have more than 40 attendees from 35 member institutions, almost half of our credit union membership. We also have one prospective member in attendance. In recent years, as you may know, credit unions have become a larger and a growing percentage of our membership. In fact, post the financial crisis, the Federal Home Loan Bank of New York has had the largest % increase in credit union members in the whole Federal Home Loan Bank system. We are pleased to see that credit union members have been more active users of our products, services, and programs. Today's webinar will address the challenges of our credit union members in this prolonged, very difficult operating environment we've been experiencing over the last several years. Frank Farone and Darling Consulting advise hundreds of credit unions nationwide on asset liability management issues through webinars such as these and other vehicles. And they offer our members strategies and tactics to overcome earnings challenges, manage risk, and position your balance sheets for changes in interest rates. We're ready to start, and I think we can move on to Frank. Thank you all for attending.
Okay, this is Tom again. Real quick, we hear a little static on our side here. I'm not sure if the member attendees have their mutes on or not, or if you don't, just please mute your phone. And Frank, I'm going to turn it over to you.
Thank you, Tom. Welcome, everybody. And welcome, Jose, to the Federal Home Loan Bank in New York. I look forward to meeting you. Today's session, ALCO decision making the right decisions at the right time. This is, as Jose said, this is the third part of a series that we've done over the last couple of years. And because there's such a large group of new credit unions on the line, I thought it would be helpful to just do kind of a little back to the future and take a look at what are some of the things that we did in the first couple of sessions, and I'll hit those highlights. And then we'll talk a little bit more about what we really need to do to be able to make good decisions at the right time by getting good information. If we're going to have an effective ALCO process, we've got to have good information and not just reports that we put together to appease regulators. So let's just start with a look back at what we talked about in January of 2013. You'll notice in the title I put Credit Union Survival in a Challenging Environment. That was a point at which we had a very, very low point in the interest rate cycle. We've been in a low rate environment at that point for almost 5+ years. Margins were coming down, rates were coming down. Most of your funding costs had pretty much floored out. Loan demand was pretty much lackluster, and there just didn't seem to be any light at the tunnel in terms of slower earnings and margin compression ahead. So we talked about some of the things that we needed to do in that environment. So I talked about those issues at the time, and I gave you all the basic fundamental concepts of the credit union earnings model. And by the way, these presentations are available through the Home Loan Bank for those of you who wish to look back at it. But when we talked about the basic business of a credit union back then, in effect, we compared it to a manufacturing analogy. You basically buy and sell money day in, day out. Your revenues come from the yield on loans and investments. Your raw material cost is the cost of your money, and you get a gross profit at the end of the day called net interest income. And if you think about it from that perspective, your revenues kept coming down, your raw material costs weren't going any lower, and thus the margin squeeze. And so some of the things that we talked about back then were, what are some of the things that we ought to be thinking about in that environment, as low as those rates were at the time? How do we get out of this thing? And for some of us, it was a function of shifting out of cash, right, into loans or longer-term investments. But what's the problem with that? At the same time, the regulators were putting the squeeze on you because of that NEV calculation. So we talked about the good and the bad of NEV, and why we didn't think it was a good tool for measuring, and certainly not for managing risk, but rather looking at earnings at risk. That's your basic business model. So probably one of the most important things that we're going to talk about today, once we get the numbers right, it's the whole topic of liquidity measurement and liquidity management. I'm going to hit that pretty quickly today. If you want to go through, detail, look at the previous ones. But I would submit that far too many of you, right, do not utilize the wholesale funding market as you should and as you could. And my hope today is to get you to take a closer look at how you can use those sources to your advantage. As I said in the previous 2 sessions that I had, and it's still true today, every single credit union that I work with has higher levels of borrowings today than they've ever had historically, ever. And it's still true today. I would submit that probably most of you have either lower levels of borrowings or you don't have any borrowings at all, which begs the question, how come? What am I missing here? So we're going to talk about that too, and how to utilize the whole wholesale funding market. And whether I was doing this for the Federal Home Loan Bank or I was doing it for the AICPA or the New York bankers, it's the same. I would give you the same message. We looked at the risk-return trade-offs. We're going to do that again today, right? And then ultimately, we got into strategies. And before we get into those strategies today, we've got to kind of lay the groundwork for what we need to do, right, to be able to make good decisions. If you think about where we were after that first seminar 9 months later, here we are, right, in October of 2013. What happened over that last 9 months? The last 9 months saw a pretty precipitous rise in interest rates, which created a panic in the industry, both in the banking industry and particularly with the NCUA. And so everybody was worried about rising rates. The long-term treasury went from 1.5%, that's the long-term being the 10-year, all the way up to over 3%, which created, again, a lot of panic. So the question becomes, what do we do? And as I said, and if you remember, for those that listened in, right, remember what we discussed at the time, right? For some, it was a curse. For others, it was a blessing. And as I said, I have yet to meet a credit union in all the years I've worked with them, but particularly now, that has severe exposure to rising rates. And I would also submit that every single one of you, if you run your interest rate simulations, whether you run shocks or ramps, if you run rates up 100, 200, 300, 400, the higher you run those rates, there's a high probability, the higher the level of earnings, if you're modeling relatively properly. And we'll talk about some of those things that go into that assumption process. So what did we talk about back then? I said first, the good news, rates are higher, right? All of your earnings moving forward looked a heck of a lot better, right? What's the bad news? NEV was getting smoked, right? NEV looked a lot worse because now your up 400 scenario was really the equivalent of an up 500 100 basis points ago. So all of a sudden panic set in. Regulators came down hard on a lot of institutions, right? And so the question becomes, what do we do? And back then we talked about the very first step that we need to do, which is what we're going to talk about today, is we've got to get the numbers right. So I gave you some case studies, and if you didn't listen in, I would go back and take a look at those. To date, I've done 24 documented resolutions for credit unions, and I can tell you, of the 24, 23 of them all had the same exact issue, the same concern, and the same solution. And I told you guys what that was last time, and I showed you the credit unions. I showed you what their earnings at risk look like. I showed you what their NEV looked like, their long-term asset-to-asset ratio. And what do you think the regulators were focused on? Long-term asset-to-asset ratio, NEV. And what was the first thing we did in order to be able to support our position? As I told you, the best investment you can make is an investment in a core deposit analysis, a core deposit study. And by the way, that is not a commercial for core deposits. I got through every single one of those documented resolutions, right, with the regulators. We came through with flying colors, all because we were able to provide good information and be able to support our position. We're not going to use par, and we're not going to use 2.5-year average life of the nearest study, and I'm certainly not going to use 8 years from some other vendor that we all know, right? So those are the things that we talked about, and now the question becomes, what do we do today? I guess this month marks the end of, right? The quantitative easing, and so the question is, what do we do now? As I said, the most important thing we need to do is get a good handle on our position. And then I can give you multiple strategies. So let's just talk about some of the things that we look at. How about a gap report? Right? When we look at a gap report, and some of you do, right? Theoretically, right? If I look at the 1-year gap, how many more assets do I have repricing than liabilities, or vice versa? And whatever that number comes out to be, theoretically, I multiply that times the change in rates, and that's supposed to give me the change in my income. That never works. It never even comes close to working. In theory, looks good, but it doesn't work, right? And so I'm going to give you an example here. Here's a gap report that's being used as a measurement tool. And by the way, these are real numbers, right? So if I look at a 1-month cumulative gap, most people don't look at that. But if I take this first institution, they've got a positive gap in the short term. 1-year gap, slightly negative, right? Over here, in institution B, what do we have? Right? Over here, what we have is, geez, both short term and long term, right? We've got a lot of exposure, from a gap perspective. So now, right, if I were to ask you which one's more liability sensitive, you'd say the one on the right. The reality is they're the exact same institution. I don't care where you put those non-maturity deposits in the gap report. It's irrelevant from an earnings simulation perspective. Here is that institution. And this, by the way, is a credit union. Near term, in a rising rate environment, a ramp up to, we got a little exposure, right? And then happy days are here again. What's the greatest exposure to you and to just about every credit union and bank, in America, right? Maybe the world? It's falling rates. That's rates going down 100 from where we were. That's not too far away. We were at 315, minus 100 is 215. We were in the 230s the other day, right? Here are 3 profiles of NEV. And if I were to ask you which one of these has the greatest exposure to rising rates, you'd have to say this one. Heck, their capital almost goes down to a little over 2. This one's okay, but you know what? This one, heck, they do pretty darn good as rates rise. They are best positioned for rising rates. The reality is they're all the same institution. And so can you imagine if, looking at those 3 profiles, we started to make decisions for a balance sheet based upon those 3 different risk profiles? One, you'd say we've got a lot of exposure. Stay short on the asset side, perhaps extend the funding. The other one on the right, you'd say, geez, we've got plenty of capacity to put long assets on, without putting on, long funding. In today's rate environment, the more capacity you have to put on long assets, right, the better off you are. I could take that same institution, and then I'm going to add in some more stressful rate scenarios. We went through that, up 2, up 4, up 500 flattening. The biggest risk to all of you is a falling rate environment. So a couple of quick things on NEV. Here's the myth, and the myth is, but yet the regulators love this, right? NCUA, I'm telling you, you all know who the largest credit union in America is. And if you took the top 3, I can tell you the top 2, that we work with, right? They still fight the same battle, just like you do, when it comes to NEV from a regulatory perspective. Everybody does, and that's why it places a premium on the importance of you to be able to articulate your position to the regulators. And we went through a lot of this stuff in detail, but I just want to kind of hit the highlights. It does not provide a reasonable indication for your earnings at risk. It has zero, right, predictive capability for your capital at risk. And it has nothing to do with, right, the value of your organization as rates rise or rates fall. The reality is it's a liquidation calculation. At the end of the day, that's all it is. So understand what it tells you, understand what it doesn't. And if all you get out of today's presentation, I hope that's not the case, is make sure you have a good understanding of what NEV tells you, what it doesn't, a good handle on your non-maturity deposit base, and I'm telling you, that's going to go a long, 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 long way in terms of helping facilitate decision making, as you'll see as we go through this. So what's the best way, right, to look at your interest rate risk position? We believe very, very strongly it's net interest income simulations, because it captures all the dynamics within your balance sheet, caps, floors, repricings, right? Here's the key: quality of the data inputs. The old expression, he or she that controls the input controls the results. And if we don't have good information going in, we're going to have poor results. And unfortunately, and this is not a criticism, but all too often, right, we don't spend enough time. And I'm going to show you how we go about putting what we believe are reasonable assumptions into our models that you can use. The utility of scenarios. How useful, by the way, is I showed you these graphs over here, right? This is base case. These are all static, no growth, right? That's rates down 100, yield curve flattening, right, just on the long end. And this is a ramp of 200, right? How much utility do you think there is in showing a 300 basis point instantaneous and permanent shock to interest rates? Has that ever happened? Has it ever come close to happening? Right? I can tell you it hasn't. And I can support it with a lot of information, data, and graphs if anybody cares. It's something that we put together, we provided to the regulators, and we said, you know what, we'll run these things, but we're not going to manage to them. Assumptions, back testing your model every quarter. How close were we, and where were we off? As opposed to, it's close enough for government work. And then stress testing your key assumptions. How many of you, and I'm not big at doing poll questions, they take too much time, but if I were to ask you, how many of you in a rising rate environment stress test your non-maturity deposits in terms of migration? I would submit that probably most of you have anywhere between 35 and 50% growth in your non-maturity deposits over the last 5 or 6 years. So is it reasonable to assume that as rates rise, you're going to see migration and shift of at least 25%? I think it's reasonable. Yet, how many of us do that? And you're going to get very, very different results if you do that. Those are absolute key. And then how do you present to the decision makers at ALCO? Do you give a big, thick packet of numbers and data as opposed to, simple, easy-to-read graphs along with some executive points? And I'm going to show you some things that I think would be helpful. What's your simulation horizon? 1 to 2 years? Or do you go out 5 years? Do you see why if I only look at 1 to 2 years? 1 year I couldn't tell much. 2 years I really can't tell. Once you get beyond 2 to 3 years, you see a significant change in the results. And if you look at even your gap report, I would suggest that probably 75 to 80% of all of your assets reprice within 5 years. Within 5 years. That's not a lot of extension risk. Right? And so having a little near-term exposure rising rates, right, isn't a bad thing because of the steepness of the curve. So here's just a quick 1-year simulation. And it looks like, hey, if rates go up, we're going to get squeezed. Rates go down, we're in trouble. If rates stay the same, we're going down. That's, by the way, very typical. Right? If I look beyond that, clearly, rising rates is our friend. This particular credit union probably has a lot of core funding non-maturity deposits. Right? Now, Here's the problem. I'm looking at earnings at risk. Earnings, the higher rates go, the better off I am. Now when I look at value at risk, meaning NEV, look what happens. So what's going on? These tools give me two different indications as to my exposure to rising rates. As I said earlier, this is what I would focus on, earnings at risk, not value at risk. And the other thing over here is, what are the underlying assumptions that are most critical in this EVE calculation or NEV calculation? It's the value of the non-maturity deposits, right? Understand why there are differences here. Ooh, sorry. Okay. Okay. Assumptions. Right? You know, this is the hard part, right? Nobody wants to get down and roll up their sleeves and get into the assumptions, but it's absolutely critical. And the regulators, by the way, they demand it. Institution specific. I looked at an ALCO package yesterday from a credit union that sent it to me, and it was not something that I would use if I were in charge. Let me just say that. And one of the things they had right up front was the methodology that they use, or the assumptions that they use for an EV. And they use three different sets of numbers. One is par, so 0, right, value, everything's at par. The second one was 2.2 years based upon an NERA study, that NERA study, which, by the way, is not very useful. And the regulators don't hold to that. And lastly, another one that came from somebody that they pay to give results of credit union average maturities, and it was 19.8 years, right? That's far off too. So it was not very good, and it certainly wasn't institution specific. So how do we do that? The old good enough for government work, that's not good enough anymore. We really got to evaluate every single quarter, and we got to update these things regularly. Do you think there's different assumptions that need to be applied when rates are rising on the long end versus when they're falling on the long end? You betcha, and I'm going to show you in a minute. How about when the yield curve flattens? How about when all of a sudden, right, loan demand slows down like it is today, and we're not even being able to hold, you know, our net loan growth? Loans are actually shrinking for a lot of institutions, right? And now it's going into investments. So it's important that you get all the key players within the organization, right, the appropriate business lines, to be able to provide input to the assumption process, right? So what are the assumptions? Critical, and I'm talking about critical model assumptions. I told you deposit sensitivity and average lives, not just from an interest rate risk perspective, meaning as rates rise, how do we change the rates on our non-maturities? How much of them are going to stick around versus migrate out? That's critical. How about replacing? New volume. Oh, and by the way, while we're talking about replacements and new volume, every so often I get a client, credit union client, that says the regulators are in here and they want us to run a static balance sheet. We talked about this in the previous sessions, and static does not mean everything goes back into the same exact product. That's not the spirit of the guidance. The spirit of the guidance is to show no growth. So why do I want to run everything back into the same category if that's not what's happening within my balance sheet, right? So we have a little difference of opinion there, but right now I can tell you a lot of the cash flows that are coming off certain categories aren't going back into the same categories. Your 2-year, 3-year, 4-year, 5-year CDs aren't going back into 2, 3, 4, 5-year CDs. And I would bet you that as rates rise, all your non-maturities aren't going to stay in your non-maturities. They're going to shift out. So at the end of the day, your ALCO package, your ALCO process, the reports that you look at should be used to facilitate dialogue at the ALCO meeting, to make better business decisions. And the best way to do that is to get good information that everybody's comfortable with, and that everybody that sits around the table feels comfortable with, meets rational expectations, and you start to make decisions off of that. If you've got people sitting around the table that say, nah, looks like we could do this and this, but I'm not really sure. Let's just kind of wait and see. You're leaving a lot of money on the table and might be exacerbating your risk. So my intention here is not to go through all these, but these are the things that we look at when we develop and help our clients to develop assumptions to go back into the model. You all have access to this information somewhere, I would hope, But these are just trends of interest rates and prepayment speeds, right? I won't bore you with the details. These are critical. What about, and again, this is a credit union client of mine. How about what's happening, what are the CPRs on the residential over time, right? By different categories, right? You can see there's a very close correlation between balances and rates. I'm not telling you anything you don't know, but you would be surprised how many people get these assumptions wrong. How about all the new volume that's coming on the balance sheet today? What do you notice here? As interest rates, right? As interest rates, we talked about 13, the end of 13. Rates are going higher. Look what's happening to our volume. Should I assume that everything's going back into the same thing? It's not. Here's the good news. The average yield in the loan portfolio of 4.21, right, is now, right, still 4.21, right? So the good news is, right, we're able to maintain the same yield. I can tell you that most aren't able to do that. And you can see the breakdown of the loans as well. How about loan originations, right? And again, look at the change, fixed versus variable. Everybody was going fixed, right? When rates were really low, curve was flat, yield curve steepened, it's shifted for this particular client. And again, look at the change in rate, and then look at the originations. Pretty simple stuff. What's happening on the investment side? One of the things you notice here is, right, look at these rates, right? Look how rates have a huge impact on, right, what we're doing on the investment side. When loans are screaming ahead and booming, we're funding loans out of investments, right, and vice versa. So again, these are just good sources for helping us with our assumption process, right? Here's something that hopefully the folks at PIMCO, right, have done, and that is, how many of you look at concentrations of your top 25 accounts? I think you'd be shocked if you haven't done this, at what percentage, right? That's a big number. Look at the percentage there. 257 million, right? That's a big number on 2.4. Look at the percentages, right, of just the concentration. Now, is it reasonable to expect that as rates go up, we're going to see some shift in the denominator? Is a fact or fiction? Well, look at institutions less than 10 billion. I know some of you over 10 billion, right? But most of you aren't. So look at compounded annualized growth from 08 when the financial crisis hit to just 2 years ago, right? 8.9. Multiply that times how many years, right? It's 40 to 50%. Prior to that, right, and I'll go back to 04 to 08, right? We had a steep yield curve. Things were booming. Life was good. Everybody could own a home, right? You weren't even growing net of interest credit. This is probably one of the biggest and most impactful assumptions in your interest rate risk management process that you really need to get a good handle on. Are we going to see a shift in these non-maturity balances? You bet. When interest rates rise, for some of you, if you've got greater than normal growth, it can be core. If you've had banks that have closed branches, if you've had failures, troubled institutions, some of you actually do a better job at increasing market share, and then some of you had the rewards checking. So even though you've had more than normal growth, some of it can be core, but I would say for most, it isn't. And so here are, and I pulled this from one of the presentations I did before, 2 credit unions. Credit union number 1, this was the shortest average life of non-maturities, right, I've ever seen for a credit union, 5.29, right? You can see some of the things that we do to come up with those numbers if you care, right? Here's credit union number 2. And by the way, both of these institutions were part of the core or the case studies that I did for those that were under this documented resolution. Both of them are extremely, extremely asset sensitive. They do great when rates rise, right? And yet the regulators were beating them up and wanted them to reduce their exposure to rising rates and sell off long assets and go short, right? This one, 7.8 years. That's about average for the credit unions that I work with. It's usually in the 7s and the 8 range, right? So if you're running your non-maturity deposits at 2.5 years or 3 years because you think that's what the regulators want, you're going to get very, very distorted numbers for your NEV, and that's going to drive you to make decisions that, quite frankly, are probably counterproductive. Right? So just keep those in mind. And then, what is the purpose of going through this exercise, getting all these numbers right, coming to the ALCO meeting, right? Some of you probably sit at ALCO and say, what the heck did I ever do to deserve to be on this committee? Others, you know, you love it. You eat it up. It's exciting. It's a profit center as opposed to, you know, a laborious session to listen to the CFO ramble on about numbers. We believe strongly that the whole purpose of ALCO, right, is to have better information to make decisions. It's a decision-oriented process, and you've got to make decisions based upon good information. That's why you go through that whole process that we just went through, right? But it should be a profit center, not just a regulatory checkbox. I showed you this before, and as I said, you know where it says manage risk? That's you guys at ALCO. Over here, that's the NCUA, right? That's just the way it is, right? Over here, put Westcore. They take a lot of risk. We got to manage all these areas of balance sheet management, and if we do, we'll optimize our income. We consider ourselves to be an ongoing concern. What do the regulators want? They want you to keep the most capital, the most liquidity, right? Keep your interest rate risk low, which by definition means what? Keep your NEV in line with what they want, using a short average life. Keep your assets short. Well, what's happened over the last 5 or 6 years as you've kept your assets short? That has not helped your interest rate risk position, right? It's hurting, and it's hurting income. And so if you do all these things, what's going to happen? You're going to minimize your income. NEV, like it or not, believe it or not, the reality is, as I said before, it's purely a liquidation calculation, period, the end, right? So here are 6 key questions you all should be able to answer. Number 1, how much capital do we need? What's adequate capital? Some of you have too much. Some of you are probably, you know, wish you had a little bit more in terms of a capital ratio. How much liquidity do you have? How much do you need? I would submit that probably most of you have more liquidity than you know what to do with, right? And I'm going to walk you through an exercise to show you how much you really do have, depending upon how you view liquidity, right? How much you want to pay for liquidity. I had a credit union client call me this morning. They are booming in terms of loan demand. And as a matter of fact, they said, Frank, we are getting so tight on liquidity because of loan demand, we need to sell some of these loans. And they are, I mean, this is all A paper, right, in Massachusetts, around the Boston market. A paper auto loans, 33 months. Anybody interested, let me know. But we're at the point now where, heck, they've used up all of their funding capacity, right? They borrow as much as they can, right? And we're doing lots of different things, right? And we may now have to go out and seek liquidity at rates that perhaps are a little higher than we would like to pay. But they're in a good situation. It's a great problem to have, right? What's your exposure to changes in interest rates? And I don't mean shocking up 1, 2, and 3 and looking at NEV, or even shocking up 1, 2, and 3 and assuming that we're going to move all of our rates up with market, right? I would submit, as I said before, most of you, rising rates is your friend. And then what do we do? So how much capital do we need, right? What is the whole purpose, right, of having capital, right? It's for stability, right? It's to be able to support your growth, right, and offset some of your credit risk. So the question becomes, how much growth can we support, right? How much of a loss can be absorbed, right, without violating our capital standards? Having more double-digit capital ratio doesn't necessarily mean we're in better shape. I'll tell you another thing I've looked at recently, and that is I looked at credit unions just nationwide, and I look at those with the most capital. You know what's interesting? Those that have the most capital tend to be the poorest performers, and their margins are terrible, right? They're living off their free money, and the reality is many of them are losing money, right? So begs the question, why don't you use some of that capital? Put it to work. They like more capital, as do the regulators. So how much liquidity do we have? If you agree with this definition, your liquidity is your ability to raise money quickly at a reasonable cost without losing money. Is that fair? That's what I teach the regulators. So this is absolutely critical and important when it comes to understanding what to do with our liquidity. Number one, theory versus practice. I just gave you a definition. I'm assuming everybody's comfortable with that. All right? How about traditional measures? What do the regulators look at? Loan to deposit ratio. Does that fit our definition? No. It implies that loans are illiquid and I can only get money through deposits. Like that movie, It's a Wonderful Life. They had a liquidity crisis at the end of the day. The reality is you can borrow against your loans at the home loan bank. You can borrow money at the home loan bank. You don't have to go with deposits. There's loans are not illiquid and deposits are not your only source of funds. I can show you institutions that have 50% loan to asset ratio, loan to deposit ratio that are illiquid. I can show you institutions that are 135% loan to deposit that get a 1 CAMO rating for liquidity, right? Short-term investments to assets. Really? If I have a 30-year fixed rate mortgage on the books today, I can call the home loan bank and I can borrow 80 to 85 cents on the dollar against that asset, right? So if I take money out of cash and I buy a 15-year mortgage back, 20-year mortgage back, put jumbo loans on the books, put 30-year fixed rate mortgages on the books, I haven't given up that much liquidity because I can borrow against it. How about non-core funding, dependency? If you borrow money overnight at the home loan bank or 1 month or 3 months, anything less than a year, that's considered volatile. You go out with a CD special at 205 for 18 months, you'll probably bring some money in. Is that really core? Which one's more volatile? I think you know the answer. Cash flow coming in over the next 12 to 60 months, right? If you need cash today, if PIMCO needs money today, there's an outflow, having cash flow 12 months out, 5 years, does that do them any good? No. The answer is no. So traditional measures for liquidity just don't work anymore. The problem is not all the examiners understand that, and the textbooks and the training that they do now, they're not trained in this manner. So the onus is on you to understand, right, this basic surplus approach. I'm not going to bore you with the details, but this is an organization that has 0 cash, but they've got all this liquidity and, right, they've got access to, right, the home loan bank, right? Now, they've used up all their loan collateral, but they can still use all that investment collateral, right? And they've got contingency sources. I won't bore you with the detail. Here's a credit union I met just the other day. First time we're at a meeting. 0. And by the way, these guys get pretty darn good ratings in liquidity. They have 0 cash. Look at their borrowings. Pretty high level of borrowings. They have no more loan collateral, but they can certainly use all this to access the home loan bank. So their all-in liquidity measures are pretty darn strong, despite the fact that they have 0 in the way of cash. If you don't understand this, look back at some of the presentations I did, and I'm telling you, that is probably one of the best starting points in terms of developing strategies and putting cash to work. You've got to get a good handle on your liquidity. So your view of liquidity, how you view liquidity, is going to have a huge impact on everything that you do from a strategy development perspective. And the reason I spent so much time on this is I know that a lot of you don't borrow money. I don't know if it goes against your grain. If you get a chance, email Tom Citino. I wrote an article on borrowing, specifically for, I think, credit unions, if I'm not mistaken, but it outlines all of the issues, business issues surrounding using the wholesale markets. And I think it makes a very, very compelling argument as to why, if you're not using the wholesale markets, you're leaving money on the table, and you're not managing as efficiently as you could, right? So how you view wholesale funding is going to impact everything that you do. Deposit pricing. You're going to tend to pay more than you have to. Or you're not going to have the intestinal fortitude to lower some of your deposit pricing for fear that what? Money's going to flow out the door. And what am I going to do for funding, right? How about your loan strategy? How many of you feel comfortable putting on long-term fixed rate assets, whether it's from an interest rate risk perspective or a liquidity perspective, or a long-term asset to asset ratio, or all the other measurements that you go by? Maybe not so much if you don't have access to the wholesale markets. How about your investment strategy? Are you willing to go out long-term, buy 30-year jumbo, Ginnie Maes, with your overnight cash? As soon as you do that, Murphy's Law says what? Oh, rate's going to go up, I can't get my money back, and loan demand is going to pick up. Well, you know what? If I have access to the home loan bank, I get 95 cents on the dollar against that 30-year Ginnie Mae. How about your growth? Some of you right now, and I mentioned this earlier, right? All my credit unions have at least the same amount or more borrowings today than they've ever had, because this is how we grow. We cannot grow at the retail window. It's too expensive, and we can't get the type of funding that we want. And if we're not getting the loan demand, what are we going to do? So I'm going to show you some of those strategies, but every single one of these, you add them all up, all these ultimately impact the bottom line, and they do. So how much liquidity do we need over the next 90 days? If you're sitting at ALCO, you measure your liquidity, and then you ask the lenders, what do we expect in terms of net new loans over the next 90 days? What are most of your lenders telling you? Nothing, flat, maybe down. How about the deposit people? Things are relatively flat, right? How much is that going to impact our liquidity? Heck, we might have more liquidity over the next 90 days. And for those of you that live in New York, I'm from upstate New York, Saratoga, there's not a whole heck of a lot of stuff going on in the wintertime from a lending perspective, right? The housing market's relatively, quiet, as is the auto market. So you may, in fact, start to see a slowdown. But this is a helpful exercise to go through. For some of you, you don't need any more liquidity. You got more than you can put to work. So this is an exercise that I spend probably the most time at ALCO. And if what you're telling me is we don't have any loan demand and our margins are coming down, what do? I guarantee you we're going to use the wholesale markets, because we have to continue to grow to offset the margin compression. There we go. Sticky fingers. This is toilet training for you guys, marginal cost of funds, right? If you go out with a CD special, if you go out at 150 and every dollar is brand new to you, it's 150. But if some of it comes internally, right, and the more money that cannibalizes internally, the higher the cost of funds at the margin. Again, you understand this. I think it's important to let boards see this as well. Now, how much exposure do we have to changes in rates? We've talked about the first few questions. How much capital do we have? Do we have adequate capital? How much liquidity do we have? How much do we need? What do we want to pay for it? Right? Now, what's our exposure to risk? Here are the four sources of risk. The one thing that I think is probably one of the biggest issues for many of you is yield curve risk. This low rate environment is putting a lot of pressure on your earnings, right? When rates go up, how many of us actually look at changes to the yield curve slope as interest rates rise? It has a meaningful difference. And then mismatch risk, another big one for you guys. And I'm going to show you why most of you have a lot of long-term, non-rate sensitive funding that you're using to fund short-term assets, which is why you do so much better when rates rise, which is why you're so asset sensitive, right? And yet a lot of that long-term funding is being parked short, which is creating a lot of margin pressure. We've got to offset that risk and bring the balance sheet more into balance. Right. Now, it's hard to see this, but yield curve risk. Right now, we are in an interest rate environment where we have a very steep, curve. I mean, right now, rates are almost zero on the short end, right? And if you go out to the 10-year point of the curve, right, we're at about 2.5%. All I wanted to show you here is how interest rates typically move when the Fed is in a rising rate mode, right? What typically happens? Let's just look at 04 to 06, right? We went from a very steep curve to ultimately the Fed started to raise rates from 1% to 5.5%. What happened to the long end of the curve? What happened to it? It actually came down. That's the worst case scenario moving forward from here is if we have what we call a bear flattener, right? If the Fed starts to raise rates in the short end and the yield curve flattens. So what typically happens when the Fed is in a rising rate mode is long rates move up, then short rates follow. The Fed tightens, we get a flat curve, they don't last very long, long rates come down, and then the short end follows, right? How many of you are modeling that scenario? You're going to get very different results than if you do interest rate shocks. Now, here's the other thing, and I'm going to show you some of those scenarios. When the joint advisory guidance came out and they said that they outlined all the things that you need to do. We did that in one of the previous sessions, right? But one of the things that we take exception to is to run instantaneous and permanent shocks to interest rates for earnings at risk, meaning net interest income. And we went back to the Flintstone age and we looked at how rates have moved. And you know what we found? The farther and the faster that the Fed raises rates on the short end, the farther and the faster they come down. And then you look at cycles and you look at behavior patterns of interest rates. And so in effect, right, in the guidance it says that your interest rate scenarios should be severe but plausible. Severe but plausible. Is up 300, 400 instantaneous and permanent severe? You bet. Is it plausible? No. So I'm not going to manage to that, but look at the rate cycles over time. This is the Volcker years, right? But if I went back to 1970 all the way to where we are today, right? The average increase over a one-year time frame was about 180 basis points, not 300 or 400. Number one. Number two, look how rates have changed. They don't go up and stay up. They go up and down. These are patterns. Why is that important? Because for most of you, right, as I said, most of your balance sheet turns over in 4 to 5 years, right? You're not going to wake up tomorrow and liquidate the credit union. So is a 300, 400 basis point shock and then liquidate a reasonable and plausible risk measurement tool? The answer is no, right? I don't have to tell you. Rate ramps, we talked about that. Rate shocks, this is a credit union. Here is the up 400. By the way, I've had so many credit unions that look at up 400 basis point shocks over a 1 year horizon, and they manage to it. Here's an up 400 scenario. Yeah, it's the worst case scenario for the first year. But look what happens after the second year. That's the best case scenario. If a regulator came in and said, gee, that's not enough, and this happened the other day, by the way. It was not a credit union, it was a bank. Frank, they mean up 1, 2, 3, and 4, average them out, and then run it up. Say, it's probably going to be somewhere in here. I mean, come on. You know, the reality is none of these are very plausible. But look what we have here. Once you get beyond year one, rising rates is your best friend from an earnings perspective. So the good news is you don't have exposure to rising rates. The bad news is that's not likely to happen. You know, in the meantime, in a base case scenario, our earnings are going down. Here's a yield curve twist. Remember I told you how rates typically move when the Fed raises rates? When we first put this into place, I think it was about a year ago. We said, let's hold short rates down for the next 18 months. Let's take the yield curve as it is today, and over the next 18 months, let's bring it up. And then when we get into month 19, let's start bringing the short end up until we get a flat curve, right? That's a yield curve twist, right? Let's see how that compares to looking at, shocks. Look at a rising rate environment, right? Up 2 and up 4, right? Look how long it takes to recover. Flat up 5, that was when Fed funds was 5 1/4 and the yield curve was flat. Look at the twist. The twist, we actually do better, give back a little, and then ultimately recover. Those are all very different results based upon different rate paths and scenarios. The question becomes, do we sit at the ALCO in paralysis, or do we ask ourselves, what's a reasonable, plausible scenario? And by the way, you notice there's no growth in any of these scenarios. We're going to show you that later. So yield curve twist, I think, is reasonable. We are going to do something very different come December for those of you that work with us. And basically what we're going to do is we're going to take the forward curve, build it in, and we're going to get that information from the Federal Reserve because they produce that every November. That way when the regulators come back and criticize you, you can say, hey, you've got the best economists in the world putting this information together. We just built it in as a plausible scenario. Here are the stress tests that we run. Right? You don't have to do these. These are the ones we do. We do a different set every single quarter. These are our recommendations for you. Right? From a reporting perspective, what is it that you look at every quarter? Is it a big pile of stuff, or is it focused? Do you use a lot of graphics? Do you use scorecards? I'm going to show you, something that we think is a reasonable, what we call executive risk summary. Here is our liquidity. What are the three things we focus on? Liquidity, interest rate risk, and capital. Right? These are our policy guidelines. And this is current versus the last several quarters. Why is that important? Trends are important, number one. Number two, right? Where are we from a liquidity perspective? Low risk. Where are we from an interest rate risk perspective? Well, looks like to me we've got exposure to the down. How about NEV? Where's our exposure? Well, we've got exposure up 3, up 3, up 3, up 3. We've consistently been up 3 over the last 4 quarters. Before we were more exposed to down, right? We got plenty of capital, right? And here's some other balance sheet information, right? What do you notice from a spread perspective? Their spread has been going up. Look at their capital. Their capital is coming down, but where did all this growth come from? Where did it all come from? Well, these guys added some borrowings, right? That's up to $75 million today. That's the one I was telling you about, right? So everything's moving in the right direction, but on one page, you can see all the 3 key areas that we're looking at, right? Now, we went through all 5 of these, and now the question is, what do we do, right? And that's why we're all here today, because I say, Frank, let's go. Let's get to it. All those things are important. The reality is, right, we've all seen pressure on our revenues because of loan demand, loan pricing pressures. Everybody wants to refinance. How much of this are we selling, right? Yields are low, right? They're not real juicy, and we're paying premiums. We can't go much below 0 on the funding costs, right? And in the meantime, here's the big one. Cost of regulation, cost of compliance, and all those high-cost asset liability management consultants. That's one of the big ones, right? Okay, so what do we need to do, right? You know, if I were going to do a polling question, I'd ask you right here, how many of you are concerned about rising rates? And I think most of us are. You know, so are you really prepared for rising rates? The question becomes, when are rates going to rise? How much are they going to rise? How fast are they going to rise, right? When you look at doing funding extensions, right, in effect what you're doing is you're buying insurance. So let's just think about an insurance policy. How much insurance do you need? How long do you need it? What are your choices for insurance? How much is it going to cost me? How much can I afford? And what are the things I can do to reduce my cost? Anytime you buy insurance, I think those are reasonable questions, right? I want to look at interest rate risk from 3 different perspectives. One is, and by the way, see this over here? This is, some of you see like an old hag, some of you see a beautiful maiden. You know, it's all a function of your perspective, right? So let's look at interest rate risk from 3 different perspectives. The regulators, what's the market's expectations, and let's look at it from your perspective. You know, and I think that's going to lend some credence to some of the strategies that we're going to do. What are the regulators concerned about? They are terrified of rising rates. Don't ask me why. I know why. Because why? They have a natural bias. Rates can continue to go higher and higher and higher, and when they do, everybody's going to leave the credit union. They're going to take their money. They're going to have to sell off your assets at a loss, and they're going to have to dip into that NCUA fund, which isn't all that plentiful, right? Your assets are getting longer. Your depositors are going short, and I don't know about those core deposits, right? This is the regulator's perspective. You know it, and I know it. What else are they concerned about? What's the impact to your capital, right? That unrealized loss in the investment portfolio. How about your liquidity? The question becomes, how does all this impact your credit union? Depends, again, on your assumptions. How about the market? What are the market's expectations? When are rates going to rise? Well, let's take a look. I can tell you right now, if the 10-year treasury is at 2.5, I guess the German bond yesterday, 10-year bond came out at below 1%. We're at 2.5. I don't think the markets are expecting rates to go up anytime soon, and when they do, they're not expected to go up all that fast. Otherwise, you wouldn't have a 2.5% treasury. So here's the 10-year treasury, right? We've seen it go up and down, up and down, up and down, up. It's up here, right? There's this resistance here. And the reality is, it doesn't appear as if the market's expectations now, we're going to be range bound based upon market expectations. Let's look over here, right? If I look at the 10-year treasury minus the 2-year, right? That's what we call the slope of the curve. These are recessions, right? What do you typically notice, right? When you get a very steep curve, right, versus a flat curve, you get flat curves just before you get into a recession, right? Look what's happened here, right? We had a flat curve. The recession hit. The Fed, lowered rates like crazy. We got a steep curve. Now what's happening? Look how much time there's been since the last recession. We're all worried about rising rates, right? The reality is the market's expectations are relatively low for a precipitous rise in rates. I'm not saying you bet the farm on it, but markets aren't expecting rates to go up anytime soon. The other thing is, what's the cost? What's the cost of extending out? This is the old hockey stick dilemma, and that is, if I go from short-term funding to long-term funding, and I'll just pick on the 3-year point of the curve right here, heck, at the time, right, that's a pretty steep curve. So there's no free lunch. If I want to buy protection against rising rates, there's a pretty high cost and a pretty high deductible, right? Now, let's look at it from the credit union's perspective. A lot of you, right now, are feeling a squeeze on income and margins. And the last thing you want to do is now add more cost on the funding side to protect against, the unknown down the road. Here's a credit union that the higher rates go, the better off they do. So they welcome higher rates. They hope rates go higher. Over here, I've got one that, they got some exposure near term to rising rates, right? If they rise slowly, I'm okay. So while some of you want higher rates, others loathe higher rates. Some of you can afford it. In this particular case, these bar graphs, what that says is, hey, if rates stay right where they are, our income looks pretty darn good, right? I got a little bit of exposure, a little bit out of my pocket today. How about this one over here? This one over here says, I'm exposed to every single rate environment. So I can tell you what these guys need. They need growth is what they need. Because no matter what they do to extend their funding to protect against this rising rate, they're going to take it out of their pocket and drive their margins even lower in the base case. So some of you can afford it. Others, quite frankly, can't afford to do that right now. Some of you might need a little bit of insurance in the near term until rates turn. Some of you need a lot of insurance for a longer period of time. And again, I don't know which one of these, is consistent with your risk position, but I can tell you what, I can't give this credit union the same strategy as this one over here, right? Some of you can self-insure. I don't really need to buy protection against rising rates because I'm doing okay here. And you know what? Given the slope of the curve, I'm going to pay as I go. Because once I get beyond the first year, everything's turning north. I'm going to self-insure. Over here, here's an institution that they've got some exposure, right, under a static balance sheet. I can tell you they're in growth mode. And they're pretty consistent with and pretty accurate in terms of their assessment for growth. So when we build in their growth model, look what happens. All that interest rate risk goes away. So that's an important consideration, right, when we're looking at our interest rate risk. I don't need to extend my funding here based upon my growth. Some of you that look like this and you have no growth, the question becomes, how do I get to here? I'm going to show you. I'm going to show you a variety of different strategies. Some of you are very concerned about rising rates, but with caveats, and that is, what's the utility of current income versus future earnings? For some of you, you might rather pay as you go as opposed to dip into your pocket today. Given all your margin pressures, kind of hard to put money on the table today to fight tomorrow's challenge, right? And if I do, look at the cost out of my pocket today, right, to buy insurance against what could potentially happen down the road. And you know what? Once I get beyond this period, I'm okay. My earnings in the meantime are going down, down, down. I can't afford, quite frankly, to pay for this. Right? So, again, hard to take money out of your pocket today. Most of you, your exposure is, the worst thing that can happen is a low rate environment, a sustained low rate environment, or a flattening of the yield curve, or we go back into a recession. Some of you, you might have some anticipated events built into your strategy, meaning maybe you're looking at a merger. Maybe you're looking at selling some branches, or maybe you're looking at adding a branch, which is going to change your risk position, right? Some of you have a high level of non-performing and REO that in a rising rate environment, if the economy picks up, heck, I'm going to be able to unload some of this stuff and reduce my problem. So these are 3 different perspectives when it comes to rising rates. So if I do have exposure to rising rates, what are my 2 most logical choices? Well, You're between a rock and a hard place, basically. You can shorten your assets, which is going to cost you money, or I can lengthen my liabilities. The question becomes, how do I do that? And again, how do you lengthen your non-maturities? You bribe them until the point where, right, they cry out and they say, I'll take it. In which case, you probably paid too much. What about CDs? Same thing. Good luck trying to get long-term CDs at reasonable rates. You can't get long-term CDs cheaper than wholesale funding. And by the way, look at your wholesale alternatives, right? If you have short-term today and you want to extend out, look at the cost of doing that, right? And ask yourself, what's the least costly way of doing this? I promise you, it's the wholesale, not going to the retail market. And are we prepared to borrow money from the home loan bank? For some of you, it's a sign of weakness. You don't want to do it. It's not good. Regulators don't like it. That's not true. It is not true at all. Read that article that I wrote. Talk to your RMs, and I'm telling you, if you're not used to borrowing money or not prepared to borrow money, you're leaving way too much money on the table. And I'm going to show you how. So what are our insurance choices? I told you we can shorten our assets or lengthen our liabilities. How do I shorten my assets? How do you get adjustable rate loans in the books? Everybody wants fixed. No, you cut the rate. You do indirect auto, right, at no spread, right? You got to give pricing incentives, right? Some of you, right, and you can now use interest rate swaps. You're not going to do that. Some of you large ones might, but the reality is for most of you, that's not even in the cards, right? Lengthen my liabilities, right? Wholesale is the most logical choice, right? So those are our choices. The question becomes, are we ready? Are we prepared for rising rates? And by the way, that's not suggesting that rates are going up anytime soon, but are we prepared? When you sit down at your ALCO, right, what's on the agenda? This is an agenda from one of my credit union clients. If anybody wants a copy of an ALCO presentation, send me an email. I'll neuter out the name and I'll show you what we go through, right? This is a pretty detailed agenda. I can tell you, I spend 85% of my time, right here. This, I spend 15% of my time going over the position. I don't want to rehash everything. I want to know what's my position, what's the expectation moving forward, what do we do? And talk about strategies, what we're going to get at. Now, for every strategy we talk about, I want to know, right, what do I expect to happen, what are the risks, lay it out, document it, quantify it, and then let's make a decision, action plan. I don't want to run out of time 45 minutes into the meeting and say, well, all right, everybody, anybody have any questions? No, okay, good meeting, have a good day, and then everybody leaves, nothing got done, right? And that's unfortunately all too common, right? So here's just an example of how you outline your strategies. Write down the strategy, write down the expected results based upon the impact it has on all these things, right? And then describe the risk. Document, right? I'll share more specifics on this. Right, now, what if you're in a market that has very strong loan demand? Very simple, right? Take your investment cash flow and fund those loans. Here's an example of an institution. This is an institution I work with, right? Where they didn't want to hold 30-year fixed rate. Too far, too long. Regulators are going to beat us up. Yeah, look at the difference, right? Your worst case scenario, flat out 5 over here, right, is better than most of your scenarios over here. Look at the impact to our earnings in the base, right, and all of the other scenarios. We're better off in every scenario than rolling our funding, rolling our investment cash flows short. And here's a description at the bottom. There's one example. Now, the question becomes, as soon as I do that, right, what's going to happen, right, as rates rise? Well, look what happens as rates rise. I'm happy the higher rates go. What I can't afford is sitting in cash, staying short, hoping things pick up, right, and my earnings go down. Right? So that's just one scenario. Some of you, particularly in the New York market, right, you don't like jumbo loans. They're too risky, right? The reality is, right, jumbo loans may not be as risky as one might think. The markets don't think it. But anyway, here's an institution that little near-term exposure, right? But look at the run rate of income. All this is, will the rates stay the same or go down? Lower. What if all we did was hold 30-year fixed rate jumbo loans versus what? Not putting them on the books, not selling or selling them, right? What a big difference, right, in income. What else could we do, right? Here's another loan growth simulation. This is what we look like before, and this is what we look like with the growth. Look at the difference in the base case scenario. Just look at the base case scenario. That's a significant difference. We've reduced our exposure to both flat scenarios and rising rate scenarios. We're doing better in every single interest rate environment versus, right, sitting here and doing nothing. And then down below, I give you very specifics as to how we funded this. And what you're going to notice is in most of these situations, you know, we've had to rely on and use the wholesale markets, right? There's another, sorry. Here's $50 million loan growth, 10-1 arms at 350. And by the way, for those of you that, you know, live close to New York City, Greenwich, right? This is where we got, this it's where these guys are, all right? So here's $50 million loan growth. This is a product that we came up with, 10-1 arms at 3.5. We funded it out of cash. They sat in cash because they were concerned about rising rates. Look at the difference. No matter where rates go, we're better off. We're going to go out 10 years at 3.5. What do you think the average life is of 10-1 arms for this particular product? I can tell you, it's pretty darn short. That's all I can tell you. Right? What if you don't have a lot of loan demand? What if your market just isn't giving you what you need? So depending upon where you are in New York, you could have slow growth or no growth. So what if we were to, and this is a small institution, right? If all we do is buy $10 million of mortgage backs, right? And here's the description down here. We're going to buy $10 million, $5 million each, of 15-year and 30-year mortgage backs funded overnight. Overnight. How many of you would go out 15 and 30 years funded overnight? Well, what's the impact? For these guys, that's a big chunk of income for them, right? Number one, what's the worst that can happen? Right? What's the worst that can happen? Right? That's the forward yield curve I talked about. They do better in every scenario. What's the worst that can happen for this? If you look at it from a transaction perspective, they make money in every single interest rate environment, bar none. So then why wouldn't you do it? Well, we don't like to borrow money. Regulators don't like it. Well, $244,000 pre-tax, post-tax, that's a lot of money for picking up the phone, right? And you're reducing your risk. And by the way, as soon as I buy $10 million of mortgage backs, I borrow from the Home Loan Bank, how much liquidity do I give up? Well, you could borrow 90 cents on the dollar, so $1 million. For most of you, you got too much liquidity to begin with, right? Now, here's the same credit union. Now, I won't drag you through this, but this was back in February. Look at their income, base case, right? Here we are in May. Now look at their base case income, a lot higher. How come? We executed some of those strategies, and you know what? We actually did 10 million more. And here are the results, right? So it's not just a one and done. If you're not growing loans, which they can in their market, we've got to look to the wholesale markets. If and when rates turn around and the economy picks up, then we'll look to doing loans. Here's another loan purchase. For some of you that can't originate loans and you don't want to go to the wholesale markets, you can purchase loans. Here's a purchase transaction. And again, look at the difference in income in the base case, in the up to, right, net. What's the worst case scenario for this transaction? I guess it would be up 400, right? Flattening, right? You still, net, you're farther ahead. It's a net positive transaction, but by the time we get to, well, you're positive, but by the time you get to year 3, where's the up 400? Right here. Happy days are here again. How about if we have cash sitting around? Look at the base case scenario. You see that difference between the bar graph and that white line? That's income going down. Our margins are coming down. So what do? Let's take some overnight cash and split it between 15-year mortgage backs at 231 and some 4-year average life securities at 222. 222 and 231, what is that? 235 or 226 on average yield, right? How many of us feel comfortable doing that? Once you do that, by the way, that's a lot of money. $2.5 million bucks, right? This is, by the way, this is a New York credit union, by the way, right? What's the best case scenario as soon as you do that? If a genie popped out of a bottle and gave you a wish after you did this transaction, what would you wish for? Would you wish for rates stay the same? Rates go up 2, rates go up 4, or rates go flat up 5? Now, most of you probably look at the results, right? The incremental results of the transaction. I don't want you to do that. I want you to look at what's my best case scenario. My best case scenario is rates go higher. I mean, heck, we do pretty darn good if rates fall 100. Is that what you want? Well, yeah, we're glad we did this because we picked up an extra $2 million, but look at our earnings. They're going down. That's not what we want. That's the difference between doing a marginal transaction or taking a more holistic approach to balance sheet management. Now, discounted 30-year mortgage backs. When the yield curve steepened up, right, you could buy 30-year mortgage backs, jumbos, in California and Hawaii that are very short average life at a discount. You could buy these things, well, let's see, down here at 374 yield, right? How did we fund these? Well, let's just think about this logically. How would you fund 30-year mortgage backs? I mean, heck, you could fund the whole thing short, given this position. We looked at using 1-year, 2-year, and 3-year borrowings, right? Look at the difference. That's a lot of additional income, and this is all wholesale. So as I said earlier, if, right, you're adverse to borrowing money, the question becomes, and it does, it impacts your pricing, it impacts your growth, it impacts your bottom line income, right? I'd have a hard time not doing this. And I ask my clients right at the table, so anybody have any questions? Anybody have any concerns? What's the impact of liquidity, interest rate risk, capital, NEV, right? You convince me why we shouldn't do this. And you know what? You can't. You can't, right? If we've done all of our homework and gotten the numbers right. What else can we do? If you've got a lot of cash flow pouring in 2015, right, you guys can all get a jump start today. Look at how much cash flow is coming in, and rather than wait for it to come in and run the risk that rates don't go up, they go down, what if we pre-invest that? And all we did here is we went into some securities, borrow money overnight, buy the securities, and as the cash flow comes in, right, pay down the borrowings, right? That's a lot of incremental income. There could be an opportunity cost if this rate pattern takes place, which is a low probability, but you know what? Doesn't matter. We're making a heck of a lot more money. Other things to consider, right? If you really, really feel compelled to lock in funding today out 5 years because you look like this, right? Here's what it looks like. Question becomes, are you ready to pay that insurance today for potential risk down the road? Maybe. But if I were gonna do that, given my interest rate risk profile and my concern for rates not going up, maybe even come down or staying flat, I'd want to figure out, how do I pay for this? The way you pay for this is, maybe look what happens beyond the second year. Maybe what I do is, maybe I borrow some 2-year, 3-year money, put on some longer assets, right, to offset the cost of, I know it's a mismatch leverage, that insurance. So I'm making higher levels of income and I've reduced my risk, right? So key takeaways today, understanding your true risk profile is important. If you misinterpret, you got bad numbers, right, because of, just maybe bad data or having assumptions that aren't very reasonable, plausible, realistic, it can be disastrous, right? As I told you, 22 out of those 23 documented resolutions I went through, they had disastrous results because they had bad assumptions. And you know what? I won't even say bad assumptions. One bad assumption, the average life of the non-maturity deposits. You know what? If you don't have a core deposit study, you don't want to buy one, you don't want to pay for one, at a minimum, just run your NEV with an average life of 5 years. And you know what? You can support that all day long. don't use 2.5. ALCO should be a profit center. Good information leads to good decisions. So, how are we doing for time?
Hey Frank, this is Tom. Yeah, we're bumping our head on time. It's 3:15. However, we have one or two questions maybe to go over real quick, Frank. One was that came in, thoughts on examiners requesting shocks of 400 and 500 basis points. I mean, how do you fend that off? What do you say to them, and how do you address that if it shows that you have a lot of risk under those scenarios?
Yeah, once again, it depends. Are we looking at earnings or are we looking at NEV? If we're looking at NEV, that's not very reasonable or plausible. We'll run it. And you know what? I assume everybody has policy guidelines, right? But our recommendation is put in policy guidelines for up 1, up 2, up 3, up 4, like the ones I showed you in that one executive list summary. For every 100 basis point rise in rates, use 10%. So up 1 is minus 10%. Up 400 is minus 40%, based upon, right, non-maturity deposit study or numbers that are reasonable. That's number one. Number two, put another policy guideline in there that says, we won't dip below, right, pick a number, 4% NEV ratio in an up 400 shock. I would never go up 500. I just wouldn't go up 500. It's not reasonable or plausible. So I wouldn't even run it, quite frankly.
Lastly, I have one more question regarding the NCUA and their opinion of embedded derivatives. I know the Home Loan Bank of New York, we speak to our members about embedded derivatives. What do you see out there with regard to the NCUA, and how do they feel about using those in term borrowings?
You know what? I would submit that, and this is probably not fair to say, but I'll say it anyway. I'm not so sure they necessarily understand them, number one. Number two, when it comes to embedded derivatives, it depends. What are we talking about? We're talking about callable borrowings, where Home Loan Bank can call it away. Are they calling about maybe embedded floors or embedded caps? Anything that you do should be done within the context of your balance sheet, which begs the question, when we embedded these derivatives, what was the purpose? Were we buying insurance against, an event that hurt earnings, right? And if so, by definition, if we end up collecting on that derivative, then we've got a lot of risk underway. If I don't collect on it, then, you know what? It served its purpose. Think about it like life insurance. You buy life insurance. You never want to collect. You hope you keep paying that premium forever and ever and ever and ever. You buy it because you can't afford not to. So the one thing I would say, though, Tom, is all too often, folks that take down some funding structures or take on derivatives or embedded derivatives don't really truly understand how to value the option, and therein I think lies the problem. And my guess is specifically you're talking about maybe callable advances. I would submit that, and I know that the regulators right now, they think that derivatives, caps, and swaps are the panacea. That's a silver bullet for credit unions to protect against rising rates. And I've seen a situation where they encourage the use of derivatives, including swaps. And I've had more requests for doing education on interest rate swaps. And as I tell these credit unions, you know what? I can give you the education. I'm not so sure you need to buy insurance against rising rates using a derivative. I'm happy to educate you, but understand how to use them. That's all.
All right. Well, we ran out of time, Frank. I just wanted to thank everyone, and Frank, thanks for this great session. Appreciate it. If anyone has any additional questions, you can feel free to contact myself or Alex or Angel Santos. You could send us an email, and we could forward it to Frank. We will be sending out the webinar links. We're going to send this one out shortly, in addition to the past webinars, if you wanted to see them as well. Additionally, there's going to be a short survey at the end when you exit the webinar. It's going to be a little survey. If you wouldn't mind filling that out, we'd really appreciate it. And then lastly, if you ever wanted us from the Home Loan Bank to come out and discuss some of these concepts with your board or your management team, again, feel free to reach out to us. So thanks again, Frank. Thank you everyone for attending, and I'll see you again soon.